Hello and welcome to the Real Vision Daily Briefing. I'm Maggie Lake, and with me today is Dave Floyd of Aspen Trading Group. We're going to talk about where Dave sees opportunity in this market. But first, let's get a quick snapshot of the action this Monday. U.S. stocks mixed. The Nasdaq pushed higher, led by a rally in technology. The S&P 500 also up, but the Dow lagging. Now, Dave, I know that you've been closely watching the action in the S&P. What do you make of this rebound that started last week? How are you feeling as we begin this new week?
Well, yeah, thanks for having me, Maggie. Trying to leave opinions aside based on everything that's happening, meaning, higher inflation, weaker bond prices. You would say that this is kind of odd price action, but I'm trying to look beyond that. The market's obviously moving higher. The only thing that I would say that I'm looking at from an objective perspective are some of the levels that we're at right now. 44.71, 44.73 if my chart happens to be up. As you can see, that's been a pretty key level going back all the way in October and all the way back into September. Marked the high overnight, almost the high. We got almost to there. We sold off coming into the New York Open, and guess where we're closing? Just slightly above that level. So what it basically tells me is there's somebody out there in large capacity wanting to buy stocks and vis-a-vis doing it via the S&P 500 futures. So there might be a lot of clouds, so to speak, in terms of inflation and whatnot, but the price action says otherwise for equities.
Yeah, and it's interesting because and for perspective, I know some of our viewers are very familiar with your strategy, but you kind of try to take the emotion, take some of the headlines out of it, and really focus on those fundamentals. Are there specific techniques you use? Are you really about support and resistance? What are the technicals that you're really relying on to try to give you some clarity in this market?
Well, I am trying to make it as objective as possible. For years, for anybody actually, it's so easy to have an opinion and kind of let that filter into one's analysis. And, sometimes that can be good. But I think it takes a little bit of experience to kind of know when to turn that on and when to turn that off. So what I've tried to gravitate over the last few years is to become just more objective, basing my analysis on price levels that are mathematically derived, not just by me drawing little horizontal lines on charts that would be arbitrary. I'm trying to look for, price, volume, time, things, measures where activity actually took place, because I believe that's what the overall market looks at. You're basically leaving footprints, and I'd like to take my cues from those footprints. So I've tried to evolve into much more of an objective levels-based trader. So a day like today, where we've got that 44.71 level really, presenting itself yet again, that leaves a lot of clues. I mean, maybe we fail again here, but the tape feels kind of firm. And, if we close above it, probably means we're going higher.
Does it matter to you what's leading the market? I mean, do you break it down into subsets? Because it's interesting that we saw technology rebound, and I'm sure a lot of people are scratching their heads because we'd seen people get so negative on big cap tech, feel that that had played out. Does it matter to you sort of what's going on underneath?
Yeah, absolutely. And, I'll look at these same levels across a variety of instruments or even market measurements. I'll look at these same levels drawn on an advanced decline ratio, drawn on the VIX, to try to get a sense of what's actually happening under the hood, as you're kind of alluding to, because that then gives you a sense of, okay, we're testing a pretty key level, let's say in 10-year notes or in the euro, or in this case, the S&P 500. Does the underlying story or the underlying technicals on the supporting characters, so to speak, does it support that? And if it doesn't mean that the market won't go higher. It just means that, maybe it's not the super foundation you would like to have a really high conviction trade. So
Yeah.
yeah, you have to look at all those other things.
Yeah, the marketing weak hands, I think, is what they like to say, right? Which can be frustrating. Does it feel like, based on what you're watching and what you're seeing, that we have the potential to take out record levels here? I mean, does it feel like that?
It's funny. It's starting to. If you'd asked me this a week or so ago or a week and a half ago, I would have said, you know what? All these rallies keep failing. Again, that's, that you're taking the temperature each day, each hour. And a week and a half ago, I would have said, yeah, these rallies keep failing. We can't seem to break to new highs. Now, boom, last week, everything changed. We had horrible inflation data, but market didn't care. Bond market kept selling off. We get yields above 1.6 on the 10-year. And here we are, 100 points higher in the S&P. So again, I'm not trying to outsmart the market. That's impossible. So it is starting to feel as though they want to take them higher. And I
Yeah.
guess, like I said, if we can stay above 44.71, 44.74, there's no sense in overthinking it. That's where the market wants to go.
Which is amazing, and certainly is not what we were looking at, the picture we were looking at just a couple of weeks ago. I mentioned technology sort of leading the way. That's got to make Kathy Wood happy, and her funds. We know how she feels about some of those, big cap names and the mega trends she watches. And you are keeping a close eye on the ARK ETF. What are you seeing there?
Well, I mean, recent price action is quite encouraging. Up on the screen right now, I have a 4-hour chart, and I can actually, it's a 2-hour chart. I can switch that to a daily in just a moment just to give some perspective. The only thing that's happening right now with the ARK Innovation Fund is it has a lot of back and forth price action. So from a swing trading perspective, there's definitely some movement to be had. And we closed above some pretty key levels last week, above 115, which we'd been testing and retesting throughout the summer. Um, you know, the chart really doesn't make me a raging bull or a raging bear. It's kind of a sideways chop fest, but there are swing trades in there. On a daily chart, though, the fact of the matter is we're well off the highs, and some of the facts surrounding inflows into ARK. A lot of it came at the beginning of 2021, and we're much lower than we were now. So there's a lot of quote unquote new money in there at much worse levels. For me, I'm looking for anything below 106.37, which we held like a rock back in looks like early October, now late September. Anything below there, the quote unquote diamond hands, I think are going to start being severely tested, because everybody's a long-term player until they reach their uncle point, and then they suddenly become a puker.
Yeah.
And I'm not saying that will happen in ARK, but it hasn't done a whole lot. And, the trajectory right now seems to be lower highs, and that's usually not a good thing you want to see.
Now, is there a correlation between the performance of that ETF? Would you feed anything into the performance that you'd be looking for in the broader market when it comes to technology?
Maybe, it's a great question. I haven't really done any, hardcore correlation studies between this and the NASDAQ and or the S&P 500. I look at it kind of more casually. If ARK is down pretty big on the day, I'm really reluctant to be, buying rallies and whatnot, because that means the overall tape in technology is pretty weak. But I would say that the fact that this can't seem to get out of its own way, despite the indices being at new highs, is interesting. But that's kind of the whole nature of our market right now. Everybody keeps looking for this correction that has been so elusive. But if you look at the underlying components of the S&P 500, a lot of them have had a major correction.
Yeah.
So it goes back to just a very top-heavy market in terms of a few names continually driving prices higher. So it really gets hard to say, well, hey, this sector is getting beaten up, so therefore it's going to drag the S&Ps down. Well, sometimes it does, but sometimes it just doesn't. So yeah. It's a quirky market, to say the least.
Yeah, it is, and it's why it's so hard for people who are trying to make decisions, and why it's so helpful to have a perspective when you're looking at the technicals versus somebody who maybe is following the tape. I mean, we're in the middle of earnings right now, and I think Tesla out after the close tomorrow. Some of the big names in that ARK fund will be reporting. So it's interesting to have a couple of different things to frameworks to use as you're trying to figure out what to do. Just a quick question, Dave. I'm wondering, when you said it may sort of put pressure on some of the holders of that if it continues to test those levels, does the time of year have anything to do with it? I know you operate in quite a short-term time frame when you're looking at some of the moves you try to capture, but we're heading into year end, and even the most convicted holders or investors want that year-end performance to look good to the people they have to answer to. Does that put additional pressure on?
Oh, absolutely. At the end of the year, most portfolio managers, they want to be neck and neck with their competition down the street, because that's called job security. I don't necessarily agree with it from a best product perspective, because if you're just trying to keep up with the guy or gal who's in your sector of fund management, that's not really a very objective or creative or, let's say, above average way to run a portfolio. But if you're sitting on a bunch of dogs and that's going to come up in your first quarter meeting and it shows up as you own them going into the fourth quarter, guess what? You don't want them there. You can kind of wash your hands and say, well, I got rid of those.
Yeah.
It's kind of like, cover your, the CYA type of move.
Yeah.
So that definitely could. I think that's a great question, actually. I mean, some of these laggards, if they're in the portfolio, they could get tossed out because then, quote unquote, you did the right thing. You got rid of those at the end of the quarter, and you can keep your job.
Yeah, and you want to be aware of that, not get sideswiped by that. Even if you are in it for a longer time period, time frame.
Mhm.
Yeah, I want to get your thought on something, Dave. We're talking about how hard it is to take all this into consideration and to try to capture that. Jack Farley sat down with Rick Bensignor to talk exactly about trading strategies. Have a listen to what he had to say about timing the market, and we'll pick up on the other side of that.
Sure.
It occurred to me that having traded in the pit for 12 years before I went corporate, it occurred to me that the most money is made in the markets at the turning points if you're properly positioned. So let me give you an example. If the stock goes from 60 bucks up to 100, pulls back to 80, goes up to, let's say, 96, and pulls back down under 80, you're going to say double top. It broke the middle of the, let's say, M pattern. And you're going to sell and say there's weakness, more weakness coming. When you do that, that's fine, except you've already missed, in theory, 20%. By the time you decide that that is a top, a stock peaked at 100 and you're selling it beneath 80. You might make money because it goes down or sell out and buy back cheaper, but you've missed a heck of a lot of opportunity. Think about that on the same thing on the downside. A stock goes from 50 down to 20, up to 45, down to 22, goes back up again. By the time you decided that's a good double bottom and things are fundamentally improving, you're way off the lows. So you're essentially only going to catch the fat part of the bell curve and you miss the tails. If you play the fat part of the bell curve, it's very hard to outperform over time because you're in that first standard deviation of trading opportunity. And for every time you kind of buy low and sell high in that, you're also going to buy high and potentially sell low. That stuff washes itself out, so you get the average return. The only way you can get above average return is essentially differentiate yourself from other people on the street, is to consistently get long near the lows and get out near the highs.
And again, that interview will air tomorrow and is available to all tiers on Real Vision. So, Dave, how do you sort of grapple with the issue of timing, especially when you're trying not to lose out on some of these moves?
Well, I think that little nugget that we just listened to is incredibly insightful and spot on. But at the same time, at least from my perspective, and I think most professional traders would agree, it's challenging to do. It's really challenging to kind of, stick your neck out on the line and say, okay, this is the level that I'm going to get in front of, because those are usually the most uncomfortable trades. I mean, let's face it. It's a lot easier to let prices hit a particular level, move lower, let's say, because you're expecting them to move lower, and then you get confirmation. You're like, okay, I was right. Now it's safe for me to go in. Now, that's not always a bad thing. I trade like that very often. It's very rare that I'll just kind of jump in front of the train up or down. But he was absolutely correct. You want the meat of the move? You gotta play the game, and you gotta play the game at that level. And that can be hard. That can be really hard to do, because you're basically saying, I recognize this as a level, and I'm damn well committed that the rest of the market is going to see it the same way. And yeah. That's a pretty high conviction type trade to take.
It is. It's aspirational, but as you say, extremely difficult. It's a good old buy low, sell high. We all want to do that, right? But yeah. a lot harder to gauge that. We have a question coming in while we're on strategy. Wanted to get this one in there from Jonathan on the exchange. Which combination of indicators do you use to set up a winning trade?
Well, it's a whole host of things. On some level, it can vary from trade to trade, but by and large, the main thing I'm looking for is a level that the market is going to react to. That's the number one thing that I like to look at. I think that, looking at oscillators can be helpful to kind of keep you out of getting into longs when the market's overbought and getting into shorts when the market's oversold. But I use stochastics, which is the oscillator that I use. I use them sparingly and with discretion. But, by and large, to answer the viewer's question, I'm not looking at a lot of indicators, and there's nothing wrong with using indicators. Christ, I came up through the ranks using them. It's a great way to get involved and help you to kind of guide yourself through the trades. But for me, it's really boiling down to now all about levels, but then using, my years of experience and drawing on some other things that are maybe a little less, objective at times and just drawing on some market experience. But for me, it all begins and ends with the levels because I'm finding those to be the most effective.
Fantastic. And Jonathan, I hope that answers your question, but great one to ask, to bring it back to the strategies as we talk about some of these issues. I want to touch on Treasuries.
Yeah.
And maybe around this inflation. So I'll do the fundamental side and pick up on the levels and see if we can match this up, because we've seen a lot happening with bond yields and currencies as everyone is so focused on the inflation story. We've got, WTI anchored right above $82 still.
Mm-hmm.
That's just holding firm. And that's really fueling this idea that we're going to see interest rate rises from central banks around the world. There's, I should say, fueling the idea and the debate, because not everybody thinks that. People still think that that's overplayed. But for those who do believe it, we're seeing market action around that. How are you seeing that reflected in the technicals around the 10-year, the U.S. Treasury 10-year?
Well, the chart I've got up here, I knew we were going to be going on to this particular topic next, so I loaded the chart of the 10-year note, the yield on the 10-year note, not the actual 10-year note itself. And, we closed today at 1.58%. I think anybody, with even, minimal powers of observation can see that we've been trending higher since the end of the summer. And if that's what transitory, quote unquote, inflation looks like, I have a difference of opinion on what the word transitory means, because the bond market sees it quite differently. Now, that being said, ultimately, maybe this is a transitory thing. Maybe it's all related to supply chain issues. And maybe once either supply chains get, rebuilt, so to speak, or maybe demand peters out, maybe we do get prices to come back down. But right now, the bond market clearly thinks that, inflation is a problem. And I think most consumers, if you want to look at an objective measure as opposed to some, nuanced measure that the government likes to dream up, there is inflation out there. For me, technically, 1.66, which is this purple horizontal line on my chart right here, that's really the line in the sand for me. I mean, I think if we get above 1.66, I think we could, rates could easily go towards 2%. And the fact of the matter is the equity market's not priced for 2% on the 10-year note. And I think that could, and I emphasize could, that could create problems for equities. But I'm taking it one step at a time. For me, 1.66 is kind of the line in the sand. But for right now, the trend in Treasuries is clear. It's down, which means yields are moving higher.
How is this, rate talk influencing currencies? Because you would think you would start to see a lot of action around that. Certainly you have when it comes to things like the Kiwi, the New Zealand dollar, although some wondering if that's been priced in. What else are you looking at? What crosses in the fiat world are you looking at where this may be playing out and present some opportunity?
Well, FX has been pretty dull of late. I mean, compared to, let's say, what's happening in equities and in bonds or the fixed income market. But, last night we had the New Zealand dollar, squiggle higher because of the higher inflation numbers coming out right there. We get the Bank of England coming out very soon, and I think that could ultimately be an inflation issue over there. For me, the easiest way to kind of track what's happening by and large in G10 is just to simply look at the dollar index. And, for me, the dollar index, generally speaking, pretty bullish. We've had a phase since the end of September where we've moved sideways. But the thing that you'll note once this chart loads is that we're kind of within this very narrow range of about 93.83 up to 94.37. So until that level is severely broken on the downside, the dollar index to me is going higher, which is basically tracking what rates are doing. Now, if rates continue to move higher, The yen's going to continue to get weaker. I think that's probably the easiest correlation play out there. Higher U.S. rates equals a weaker yen, which means a higher dollar yen and a higher Canadian dollar yen, a higher euro yen, et cetera, et cetera. That's probably the cleanest interest rate play in the currency markets, is to simply look at the Japanese yen.
Yeah, the currency market, fiat currency market, has been a little dull lately, but crypto has not, Bitcoin has not. Again,
Nope.
some of the biggest moving markets that we've seen, making another run at that record level.
Yep.
A lot of questions coming in about that as well. Why don't you just set up for me, if we look at Bitcoin, what you're looking at from a technical perspective, and then we'll go through some of the questions that are coming through, Dave.
Well, in all fairness, I don't trade crypto. I do keep an eye on it because it is obviously a part of the ecosystem, and it does have an impact on the markets I trade. And I mainly trade S&P futures, 10-year notes, and a handful of currencies. But the fact of the matter is, crypto is part of the ecosystem now, and I do have clients that want to know about it, so I profile it.
Mm-hmm.
And again, I use the same mathematical levels that I use on any other thing that I trade, and this is the type of stuff that I post for them. And 60,000, I mean, again, it just happens to be a round number. I didn't make it that number. That's what the math is telling me. 60,000 is the big level. I mean, we're holding there. We broke above, we've held. Ethereum had a big breakout above a resistance level last week too, which was kind of not a surprise, just given how strong Bitcoin was. It seemed like it was only a matter of time before Ethereum played catch up. So again, technically speaking only, seems like crypto, unless we break back below 60,000, we're probably going to squiggle higher. At the next big level on my chart, as you can see here, is up towards 68,700.
Yeah.
And the prices could get there very easily. That to me is the next magnet price that I think that we're likely to see in crypto, absent a break below 60,000.
Yeah, and this has been moving. I mean, I think this month alone, it's something like up 43% or something like that. So it's been really rapid, that rebound again. Any thoughts on talk of the ETF coming out? Do you have any perspective on that? Is that something that would interest you?
You mean in terms of trading it, or
Yeah, in terms of trading it. Yeah, we've got a couple of Andrew, Brian, Bo, a lot of people asking about this online. Your thoughts about it?
Well, I mean, I think at the most basic level, it makes it easier for most people to get into. If you're managing your 401k or your IRA, it's probably a whole lot easier to have your, to buy an ETF version of Bitcoin than it is to go out and buy the Bitcoin itself. Although I'm not familiar with all the retirement rules of whether or not you can put this in an IRA or not. You may very well be able to. Mm-hmm. I mean, I think it obviously legitimizes the industry, although the only thing I would say is that whenever you get to these turning points in quote unquote hot markets, like Bitcoin tanked when I think it was El Salvador, took it on as their quote unquote official currency. So oftentimes these hallmarks or these milestones tend to be kind of inflection points, and usually not for the good, so to speak. Yeah. But that might just be temporary in nature. So I know there's the ETF coming out. I think it's this week, if I'm not mistaken. And if it does reflect or if it does track the price of Bitcoin or whatever it's designed to do, that's great for retail investors. The more options they have and the more transparency they have, the better.
Mm. We have a question from Bo related to that, about whether cryptos say subprime crisis. Everybody thought they knew what they were holding. Everything was supposed to be fine until the curtain went up. People feel very strongly about this topic. But that aside, do you look through your strategy at any kind of systemic risk that would carry over from something like the crypto market? How interrelated are markets right now? Or are they kind of operating on their own fundamentals?
Well, it's interesting. I read a great article last night about something quite similar. And, cryptos has not been around long enough where you can draw these long correlations like, systemic risk should equal X, Y, and Z in crypto. It's a logical conclusion to draw, but there's no historical evidence that that's the case yet. Doesn't mean there isn't, but it's just we don't have it. But to answer the latter part of your question, are markets moving? Is each asset class moving under its own, set of rules? I think that can be the case on some level, as we talked about early on. A lot of individual markets and a lot of individual equities have already had corrections, yet the indices keep marching higher. So there is a lot of movement underneath, and if you're just looking at the indices day in and day out, it does mask what might be happening in other sectors unless you're kind of actively looking for it. So I'm not sure that answers the question, but that was
Oh,
my
I think
take.
it does. I mean, I think that I think the point that there's no history to draw on from that. But
That's
the
exactly right.
fact that someone's asking the question, I think speaks to what we all worry about, that you're going to be blindsided by something, right? It's going to come out, and you put all the work in to try to get your portfolio where you want it, and then you're going to be hit by something, out of left field that's going to carry some counterparty risk that you haven't seen coming. So I think it's sensible to ask that question.
Oh,
Um,
absolutely.
yeah, and I think your answer made a lot of sense. We just don't have the history to know what that effect is. Uh, Dave, a lot of times when we're talking about how to position, given that the sense of fear, how can I defense? A lot of people are talking about how to hedge against inflation. What opportunity do you see? What do you feel bullish about, or that you're looking at for a breakout that you think could have some real potential here, based on your time frame?
Yeah, well, my time frame, it can vary, but by and large, I'm a swing trader, so my trades last for a few, several hours to a few days, maybe a week or two.
Right, which
Um,
is important to point out because that might be shorter than what some other people are looking at. So thank you for clarifying that. But
yeah,
yeah, so in that against that time frame, what looks attractive?
right now I'm waiting. I think the next big opportunity is probably going to be in the rates market or 10-year notes. It's too big of a developing story to not have some ramification. At least that's how I see it. And again, I'm trying to leave my opinion. I'm trying to leave my ability to collectively think what the market's going to do, because that is such a monumental task to do.
Mm.
But given the nature of interest rates, meaning that that's the price of money, that is the most important market, which I think is probably not something that most people would argue. I mean, that is a very important market, a lot of really smart people in there. I think that's where the next big play is going to be. Now, does it mean that rates continue to skyrocket higher, or is there a long opportunity here because the market's gotten too far ahead of itself on this inflation, and they suddenly realize that it is transitory, and suddenly rates are back at 1.25? Well, that's a monster rally in 10-year notes. I don't know which way they're going to break, but I have levels that I'm looking at. I noted one earlier, 1.66. We get above there, it's really hard to be bullish bonds at that point, or 10-year notes, because it indicates to me that there's a lot more room for rates to go higher. I think the key thing, you mentioned counterparty risk and just risk in general. Here's the number one takeaway. It doesn't really matter what you're trading or what you're interested in. If you're sized properly, whether it be from an investment allocation or a trading allocation, if you're sized properly, that's how you're going to minimize any damage to your account, because guess what? You're always going to get blindsided by something. It's impossible to know what's going to happen next, because price action, by and large, is random. That's been proven. It's our job as traders to look for repeatable patterns, which do exist. But the only way to ultimately really kind of insulate yourself is you've really got to size yourself properly. So if you're lopsided in any one position and it takes a hit, that's on you, because that was avoidable. And I think the number one rule is you've got to minimize your drawdowns, because mathematically they're so difficult to draw yourself back from. And more importantly, they're emotionally difficult to draw yourself back from. And that's the key thing. You're so beaten up if you take a 20% drawdown in your portfolio that even if you do have some good trades, you're likely sized a lot smaller because you're nursing some wounds. And you can't do that. You got to be sized the right way in the good and the bad times.
That's great advice, and great to have that discipline. That's what we have to remember. That's why it's important not to let the emotions get in the way, right, Dave?
Yeah, exactly.
Awesome. Dave Floyd from Aspen Trading Group, thank you so much for being with us, and thanks for all the good advice. We appreciate it.
Hey, my pleasure. Have a great afternoon, Maggie. Bye-bye now.
All right, great. Come back again soon. And thanks to all of you for watching. The conversation is going to continue over on the exchange, but in the meantime, take good care and good luck out there.